Jack, how's it going?
It's going great. Loving this morning. I got to tell you though, I'm even loving that rock and roll song. You guys got your own song going on here.
Yeah, Amanda made that with some AI tool. I thought it was pretty cool.
With AI, it sounded like you
Yeah,
hired the Rolling Stones.
I know. It's pretty awesome. Dave up 500% on core. Wow. We did a speculative earnings bet on that yesterday. There's some mispricing going on in the options market.
In which stock?
COHR. It probably was my first time trading it.
Oh
We
yeah,
saw some big orders coming in, so we said let's go ahead and do this. And worked out for us.
awesome. Good morning, everybody. Albert, Larry, Doug, Costas. Quite the group here this morning. You guys are in for a real treat. Mary Alice, John Goddard. There's my man Jeffrey.
Hey, everybody.
Hey, Jeffrey.
Hey, couldn't
Well,
get
it's
my
great.
headphones to connect.
What's that?
Couldn't get my headphones connect.
Oh, no worries. Working now?
Yeah, I got y'all. Yeah, 5 by 5.
Right on. Right on. Well, I saw you guys had a fascinating conversation yesterday about basic options, debit spreads. We do a lot of debit spread talking here.
Yeah,
It's the primary way Nate and I both trade. But we've had some people ask about basic options, debit spreads, different tactics there, credit spreads, all sorts of the above. We even have some people doing iron condors, butterflies, all sorts of crazy things. But we typically stick to debit spreads. But I saw your guys' conversation yesterday. Thought it was fascinating, and was hoping you guys could take everyone through the training you talked through yesterday. I know that we got a lot of really good feedback from folks who were able to make your guys' session yesterday.
yeah. We started a brand new show called Market Masters with Jack and I. We kind of have similar ideas on the market, but we came at it from two totally different backgrounds, and we thought we'd teach a few people some basics about how you just reliably make some money from the markets. And a lot of people jump into options trading and they don't really look at the big picture. Like, what are all the different ways we can make money? Um, you know, you come at it naively, jump into this thing, you don't even know about options, buying shares, shorting shares, that's, kind of the basics. So yesterday during our show, we just kind of started there at the basics, buying shares, and then started building on that with some basic option plays and kind of compared like the return versus the risk you might have and the capital you might have. You and Graham, Graham and Nate use debit spreads. So that's, you know, pulling back the capital requirements, but still getting some of the leverage. And Jack and I only just barely started to touch into credit spreads and debit spreads because this thing's so big. And if you don't have that base knowledge, well, you're kind of playing without, it's kind of like trying to jump into a high level conversation without actually having the background to be doing that. And, a lot of people jump into options trading like, "Oh, I'll just figure it out as I go." It's dangerous, isn't it, Jack?
It
It's
is very
dangerous.
dangerous. It is dangerous, but it doesn't have to be that way, my friend. That's why Jeffrey and I are doing this show. We're going to take it all the way down to the basic level. Then we're going to bring them all the way back up. Hopefully, have everybody in the green making money and tuning in every Wednesday and Friday. And thank you for having us on here today,
Yeah.
Graham.
No, that sounds perfect, and that's exactly what we need. So go ahead, guys. Walk us through it all.
Yeah. So, my pick of the week on our show was Gap, and I guess I should just share the screen instead of just putting it on my overlay here, and I'll throw it up here, and let's see if we can get it thrown back up here. All right, I just crashed something. Hopefully, it didn't crash the screen. Something
I
throw.
can see it.
All
I can see
right.
Gap.
I got to pop back up the chat because apparently something crashed. I don't know. There we go. All right. So Gap is my pick of the week. We were talking about it. Jack likes to look at stocks that are in a 6 month uptrend. That's his basic core bread and butter for generating some income. But my pick of the week here is kind of beaten down and has established a pretty good bottom for the last year and a half. Now, one of the things we talked about on our show, this gap down presents an opportunity for it to come back up to that level at a minimum.
The reason for that is most gaps they're going to get filled in somewhere down the roads, and that's what we're expecting here. That big gap in pricing that you see is going to get filled in with new pricing as it gets higher.
And that doesn't just go for stocks that happen to be called Gap. It goes for a lot of stocks out there.
Yeah, this just happens to be Gap. My theory is that Abercrombie and Fitch kind of took the lead on this sector, and we're going to see some of these other clothing companies catch up. Gap, one that's beaten down. Guess is another one that I already have shares and exposure in. Gap, I played this on Monday for a short-term expiration on Friday. We'll get more into that in a second. Now, that's kind of the technical and fundamental reason why potentially bullish on Gap. Now, here we are sitting at $20.49, and we're looking for this for Gap to fill the gap to 28. That's an upside move, right? That gives us $8, roughly $7.50 of upside. Now, basic thing, if you don't care about options, you don't know about options, you don't want to be in options, the only way you can really play this is to buy shares here at 2049. Buy shares right here where we are, 2049. And if you buy one share, that's 2049. If you buy 100 shares, that's $2,049. What's your risk in the trade?
2,049. And if it moves down a penny, you're losing money. If it moves up a penny, you're making money. But there's a better way to skin the cat, my friend.
And we're trying to make $7.50 roughly. So, for people that just have never thought about this, let's go with 100 shares. So it's $750 upside divided by roughly 2050. I'm just going to round off of our risk. That's 36% upside potential right there. Now, there's tools you can use to draw it on the chart and stuff like that, but that's just nuts and bolts. Here we go. All right. Now, there's ways we can reduce this risk. We can play for less money. And that's where the power of options come in. And yesterday, Jack and I were talking about, a lot of people don't even know when you buy a call, what does that actually get you? And Jack, what does that get us when we buy a call?
That gets you the right to call the stock away at that strike price at any time until expiration.
Right. So right now we have strike prices on Gap, and I can pull those up and we can start talking about some strike prices. Pull down here, grab the option chain, and let's just fly out, about 4 weeks, about a month. So we look at this right here. Call side is on the left, put side is on the right. We're just talking about calls right now. If we bought it at the money, right at 2050, right here, about a month out in time, we're looking at spending about $1.48 right now. So these represents their price. Well, for whatever reason, options are priced in per share, and they're always in blocks of 100 shares, at least for you American style options. And so that represents $148. So now we could potentially buy this call right here, 2050, same place we'd be in with shares, same upside potential, and we've reduced the risk down to $148.
Instead of $2,000, right?
Yeah, instead of having to spend $2,049 or $2,050, we can now spend $148 and get that same kind of upside. And this is huge leverage, but it comes with huge risk. And we'll talk about that in a second. So we're talking about still the same $750 upside, except not exactly. But we're spending 148 to get there. It's a 500% upside, but it's not exactly $7.50 upside because we spent 148. So we actually have to subtract that off. It's actually $600 potential actual upside, $600 gain for our $148. So really, we're looking at a 406% upside. That's pretty.
That's why people buy calls right there. That's the biggest bang you're going to get for your buck is when you buy a call and it works, right?
And it works. Now, what are all the things we got to be right on for this to actually play out?
A lot.
We got to be right on a lot. A lot of things got to be exactly right. We got to be right on our time frame. We got to be right on the direction.
Strike.
And we got to be right that it gets to 28 to make this money or higher. That's a lot of stuff. That's a lot of stuff. And what happens if it just stays flat for the next month?
Your call evaporates, time decay eats it up, and 100% of it is gone.
Yeah, that $148,
Whoop.
gone. Vaporized. What if we go down in price? $148, gone. What if we only go up maybe to $22? Guess
No.
what? $148 is gone.
Yeah.
Made
Scott made a
$0.
big move.
So even if it goes up in your favor, this is why options traders, long option traders, especially if you're buying calls, expecting moves, this is why you can lose money. Gone. Yeah. As Bob says in the chat, just gone. Like that money's gone. You got to get it right on the direction. You got to get it right on the size of move, and you got to get it right on the time frame. If it takes too long, money's gone. If it gets there fast, great. You probably made more money. But that's gambling. Like that's the casino that we all play and trade in. People love this stuff, right, Jack? I mean,
It's the
it's
most
worth.
speculative trade you can make buying calls, but people want to see that 400, 500% gain. That's why they buy them. It's a cheap way to get in for $148, right? Versus $2,000 if you bought the stock. And that's kind of the hook is everybody wants to hit that 400 or 500, 600, 700% gain on a call, on a cheap call.
Now, some things we talked about doing yesterday, we could go ahead and buy that stock right now at the money. We spend the $2,050. But how do we limit the risk to the downside? Well, we have this other side of the option chain over here. We call them puts. If we buy a put, Jack, what does that get us?
That gives you the right to put the stock to anybody at any time till expiration at that strike.
So we could actually buy protection down here at $20 or even $1 below, give us $100 downside and spend like $1. Now that does increase our cost. So we're looking at $20.50 for the shares. If we buy this downside protection, buy a put right here, gives us $100. We'll talk about the risk here in a second, but say we buy that $19.50, going to cost us about $100. So now we're at $21.50 total risk. But no, by buying this right here, it gives us the right to sell it for $19.50. So now $19.50.
Even if the stock goes to 10, you own the right to put it to somebody at $19.50.
So now our risk in this trade, just by buying that, by spending a little extra money, we're out of pocket $21.50, but our actual risk in this trade is now down to $200 with still all the potential upside. Now,
Not bad.
Jack and I talked about ways we could actually reduce this risk even more. Now, our protection only lasts for a month, so we still have to be right on the time frame. Our protection does have a expiration date of September 12th right here. And ways we could actually reduce that even more is to sell an upside call. And you can sell an upside call anywhere you want to. But when we sell a call, Jack, we talked about we buy it, we get the right to buy that stock. But when we sell a call, what happens?
Well, we've taken on the obligation. We got paid to take on an obligation to deliver the stock at the strike at any time up until expiration. But
so if somebody,
you have
if we
to
sell
have 100 shares of gap in order to sell a covered call, just to be clear.
and that's why we're talking about 100 shares, because we're gonna package this up into more complicated trades here.
Box
So
it
we've
up.
got our shares that we bought at the money. We've got our protection we bought down here to reduce our risks down to, basically $200, even though it's $100 downside, $200 because it cost us $100 to get into it. And we can go up here and sell some upside. We don't even have to go to 28. We could go to, say, 24 and get paid $40 right here. Now we have upside potential from the current price up to 24, and we take our $200 cost and subtract off another $40. So now we're down to $160 risk in this trade, but we've capped our upside at 24, at least through this expiration right here. Now that upside going from 2050 up here, that would actually be, we have to roll back to the 2150 cost in the trade minus $40 credit we just took in for this obligation to sell at 24. So we're actually at 21.10 on total cost to be in this trade. Protection gets us down to 160 true risk, right? So this is interesting when you talk about return on risk versus return on capital used. So at this point, we're looking at a move from 2050 up to 24. 24 minus 2050. So a $3.50 upside move per share times 100, $350 upside. And if we divide by the risk, divide by 160, now we've gotten that to 218% upside on the risk.
I love this. And we're just getting started, folks.
So we've now got a number not quite as good as buying a naked call, but we've capped the risk even smaller than buying, than going with the call. And we still have a 200% upside. And we don't need nearly the move. We need a much smaller move, which is much easier to do for the stock market. With 218% upside. That's pretty good. But the downside here is it does take more capital. It does take more capital. So we have that $350 upside, and the capital that it's going to take to do this gets us a 16.5% return on our capital over the same time frame. If we actually get to the upside. If we don't get to the upside, we got to keep the premium that we got, the $40 over here, and we still have our shares. Assuming we're staying above the 1950 strike. If we get below the 1950, we can execute our long put and give that stock to somebody else and eat our $160 risk. Everybody with us so far? Any questions? It gets complicated. It is an insurance policy. If you got questions, now's the time to ask them. We'll go back through any piece of this. But if you don't understand this basic stuff, this is actually basic stuff. If you're trading more complicated things like spreads and you don't understand this part of it and how you're taking your risk up or down with spreads, you're playing the game without a full deck. This is why Jack and I are starting our show.
You've got too much money in the trade that you don't need that, right? You don't need to spend the whole 2150.
Yeah, you don't need to. This
got
is worse.
$160 risk versus 2150 risk.
Right? Yeah, and if you're in a marginable account, then and you have a broker that's going to offer you margin on this play, you're not going to be out that entire chunk of money in your account. They're probably going to hold more like 20 or 30% of that 2150 and let you play with the rest. So we're talking about capital utilization, back to the capital utilization thing. And some brokers give you bonus because you actually bought the put and may reduce your risk all the way down to the $160 risk.
Mike asks, is there a formula for what strike to choose for the put? You want to pick one that's kind of at the money, Mike, close to the price you paid for the stock. That way you just bought insurance.
Now, it does come down to other things we talked about yesterday on our show, like beta of the stock, and that is volatility compared to the S&P. And Jack, if you want to talk about beta for a minute.
Yeah, well, so this is another thing I look at on every stock. Beta is a measurement of volatility. So the broad market, SPY, has a beta of 1. Anything over 1, it means it's more volatile than the broad market. And that's what you want, because if it's more volatile than the broad market, you're going to get a little bit better, little juicier premiums, which is the name of the game. So you want a little bit of volatility and you want that directional bias.
Now, that gets us good premium for selling options. But on the flip side, high betas, bigger than 1, also cost us more money when we're buying put protection. So it does cut both ways. Now, that's kind of really, we're just giving you basic conversation, basic concepts here. Jack and I are going to expand on this a lot more. We had our first episode of our show yesterday. Graham invited us on here today to give you all a little taste, and we're going to be diving into this more and more every Wednesday and Friday as we go along. So, and we're just getting started with this conversation. This thing can build a lot bigger. We can do more stuff here. Now, that was just a way to trade this. Now, what I did on Monday, I actually jumped out here to this Friday, which is tomorrow at this point, and I sold a 19 strike put right here. I actually just sold it. What they call a naked or cash secured put. Now, on Monday, this sucker was going for 15 cents. Right there at 19.
So when you sell that naked put, you're getting paid to make a promise. The promise you make is, if the stock goes to 19, I'll buy 100 shares and I'm going to get paid 15 bucks to take on that promise. I like that business right there, because if it doesn't go to 19, you don't get assigned the stock, you still keep the money and you get paid up front. You'd think that you'd only get paid that 15 bucks at expiration if it worked, but that's not how it works. You get paid instantly right now. That money hits your account. It's guaranteed by the CBOE when you sell that naked put. So that's great. Getting paid to make a promise, that's a good business.
Now I want to show you a little bit of math behind this. So that 19 strike put, I sold on Monday. I actually did this, and if you give me 2 seconds here, I can pull it over and show you the order. Maybe more than 2 seconds. It was right here. I sold 12 of them. Got paid $15 for each one. Do the quick math on that. That was a pretty good little chunk of money.
Not
But
a bad.
I committed to buying Gap at 19 bucks on Friday if it's below 19 bucks. All right. That's cool, but how does the risk return happen in this, right? Like what did that get me? So, I committed to buying shares at 19 bucks. I got paid 15 bucks to do that. So just break it down to one option. Got paid 15. It took me, even if we don't consider margin or anything like that at a broker, it possibly took me 1,900 bucks of equity in my account to be able to do this. As the broker calls it, it's kind of like the broker's insurance, that you actually have the cash to put up to buy those shares. So that returned me 0.7%, 0.78% for the week. All right. And I may have already closed it. So right here, I did that on Monday. So we have Tuesday, Wednesday, Thursday, Friday. That's 4 days. So we divide this risk across 4 days, or divide the return across 4 days. That's almost 0.2% return per day. Multiply that out by 365 days. If I were to have done this a long time, out the whole year, that's 72% return on the money I'm using right there. 72% return. And I was down here with a very low risk, because when you look at the chart, I was under the recent price action here on this current dip. Right? It turned around right there. I was at that low, and it's been the low for all the way back here, a whole year. Now, we did spend a little bit of time here, but I also expect this thing to go taking off back up to the 28. So if I got put at 19, now I have bigger upside potential than if I just bought shares right here at 2050. I'm at 1900. Now I have a $9 potential upside right there if I got put the shares. But at this point, it looks like I'm just going to keep the money and keep my 72% return annualized rocking along. Everybody see how this is starting to stack up and be kind of juicy. Like I have, I still have the potential to get put those shares and still have that potential to ride it up there. Right there. And for those of you that, may not be grasping the whole concept here, I recently did this in a live account. Somebody yesterday was asking if Jack and I actually do this. And the answer is yes. We actually do these trades. Both of us do, different ways. But I grabbed this one on Rocket Lab, and I sold puts on it quite a bit. And then I got put the shares.
Which you
I
want,
made,
right?
I wanted to get put the shares. I made 10,000 bucks on the shares as it went higher, and I sold upside calls and made 700 bucks on upside calls that I sold against it right there. Now, we can pull up the chart and look at what actually happened. This is a beautiful, beautiful trade right here when we look at it. And this just recently happened. Would I chase Rocket Lab again right now? No, it's up here elevated. And I had this on a different chart yesterday that didn't have all my extra drawings on it. Right here in Rocket Lab, I started selling. I have a signature roadmap bounce pattern that I chase in the market. This is it right here. We came down to my roadmap line. We bounced up. We got above this 618 level right here. And that got my interest in this stock right here. Now I started selling puts. Just in case you aren't keeping track here, this is in mid-May. I started selling puts. I sold puts weekly until I got put shares on that Friday drop right there. So I collected premium for almost a whole month, weekly, on Rocket Lab.
4 times bring in money before you get assigned the shares.
4 times I collected money and then got put shares. So then I bought Rocket Lab right here. And we can actually go into my public track record. You can go to kinfo.com, look me up. Right here, that was a call. I sold calls several times before I got called out. Right here was the put option I got put. Right here. I got paid 31 cents to sell the put, and then I got to buy those at 26 bucks.
And your cost here is 26 minus 31, folks.
Yeah, 26 minus 31 per share. So I was actually at 21.69 or 25.69 per share cost.
Now, see how smart of a way that is to get into a stock? The market basically gifted him Rocket Lab.
And then Rocket Lab went on a rocket trip all the way up to my target of my signature technical pattern that I look for in the market all the time. This thing, 75% likely to work out to this level right here. Now, I sold upside calls along the way and collected premium all for another month. I collected upside premium until this thing was above my 41 strike and I got called out right over here. And that's where I got paid the 700 bucks for selling the call and the 10,000 bucks on the share gain. Plus the puts I sold before I got put so this actually turned into almost a $13,000 trade.
And cash flow. Look at all the cash flow you generated. Talk about income. You're making income, what, 7 times here plus the big gain?
Well, I mean, 4 weeks on the front end selling puts, 4 weeks selling calls. So that's 8 times plus the share gain. That's 9 times opportunity to make money.
I love it. So much better than just buying a stock and hoping it goes up, right? That's how most people play it. There's a much better way to skin a cat here, right? This is exactly it.
And if you want to, right there, the exact number of value I brought in trading there at Rocket Lab, 12,287 bucks right there. Audited by Kinfo. Right there, including all the puts, all the calls sold, and then the shares. So right there, that's a pretty good little trade. And I just started this account on tax day, basically, in case anybody wondering about how the thing got here. I actually started this basically tax day right here in April. So this will be 4 months I've been at this. Can you make money doing this? Year to date, there's the amount of money I've made in this account. We'll look at it, 23,800 bucks, 95% win rate, average gain about $265 per trade. So can you make money doing this? I make it pretty reliably.
Now, the very first step, though, is the naked put, right?
Yeah, that's the very first. Well, let's rewind just one more step. We got to find something we're bullish on, Jack, and we've got to want to own the stock.
Right.
That's step one. Find something that you expect to move higher and you're willing to own. If you're not willing to own it, or if you're like, maybe, don't trade that. Step number one. Then step number two is find your spot. Where do you want to buy it? What's the good price? For me, on Gap, when we started here, I was looking at this low. I was like, that held support. If it dips back in here, I think it might hold support again. $19 looks like a pretty good spot. Now, here we are on Thursday, and Friday's tomorrow, and this doesn't look like we're going to be below 19. So what is that? What options does that give me? Jack, what do you think I could do next week?
Again, do it again.
Yeah, I can turn around and do this again, especially with the beta.
Every week, bringing in cash every week, regardless of what the stock is doing.
Yeah, this beta hanging out right here. Now, earnings is coming up. That's an unknown. But earnings didn't happen this week. So we look at it. Earnings is the 28th. Right here. So we could do it next week and not even have to worry about earnings. We could skip the following week if we didn't want to play through earnings. But earnings may gift you that stock. And there's extra premiums usually on earnings week.
Mm-hmm.
So if we're bullish on this stock, it'd be good to play play next week and then play the following week. And then maybe play the next week after that if we don't get the shares. And you keep doing this until you put the shares. But you want to do it at support. You don't want to just chase it higher. Now, Jack has a little different opinion. We do things slightly differently on how aggressive we are. I like to trade at support. It's kind of the Warren Buffett way of, I just hang out down here and keep getting paid to be at support. And if we dip into support, I get that opportunity to buy. That's what happened on Rocket Lab. We dipped into that. We just happened to dip on a Friday, and they gifted me the stock, and then it took right off and went right exactly where I expected it to go. So that's nuts and bolts how, if you go Google it, it's the wheel strategy, and I combine that technical pattern with it, and I call it the turbo wheel. So if you Google this strategy.
The best thing I love about this is that your very first trade, you're getting paid, right? You're bringing in income as you're moving into taking the position. You're getting paid up front. I love that.
Yeah, I got paid 15 cents already. I might get paid another. We can look at next week's options. Let me scroll down here and grab the option chain again. Pop this up. And if you're wondering how to get these, tradingview.com. This is the platform. This is the charting platform I'm using. You can get all this information we're talking about right here. The beta, the options prices, all this right here on this one easy to use platform. So next week, I may go after it again with the 19 running a little light, but that 1950, that's actually running a little richer right now. Looking at 17, maybe 18 cents. So if my 19 closes out today, I might be able to roll that into a 1950 for next Friday. Now I've collected $15 plus maybe another 17 or 18 bucks per share. This starts stacking up. If I do this like 4 times, all of a sudden I've reduced my cost when I do eventually get put by $1, maybe $2 a share, depending on how long I can keep bringing in this premium. What's the account growth been over this period? That's it. Like that's the $23,000 account growth right there.
It's not too shabby.
Now, do I raise the put price every time? No, I go for the premium. I've already identified price action. Price action is an important part of this to me. Jack does things a little different. We're going to talk about that more and more on the show, how we pick, where we pick it, things like this. This is not an all-inclusive training session. This is this is the beginning of a long series that Jack and I are going to do together. So this is why you should come see our show. Graham, I don't know if you have the SMS link to register for this, but we might drop in the chat.
That, and I'll throw it in the chat.
Yeah, people might want to get an SMS reminder when Jack and I are going live, so that you can come learn some of this stuff
tomorrow.
Yeah, we're gonna be live tomorrow, going through the next step.
And what time are you guys doing that?
We are live at 10:30.
Okay.
I know 11:30.
11:30.
11:30. Excuse me. 11:30. Yep. 11:30 on Wednesdays and Fridays Eastern time.
Awesome. I'll get that link.
Terry asks, do you do spreads or are you selling naked? Both.
Yeah, there's this is just the first little piece. We've only walked through a little basic part of this, but you can get more and more complicated with this. And we can add debit spreads and credit spreads and all sorts of things. And so since the question is, what about spreads? Let's kind of broach that subject a little bit. Jack, what do you say?
Yeah, let's broach it. It's one of the best trades, whether it's a debit spread or a credit spread. They're both great trades. Uh, Graham turned me on to a really powerful way to do the spread, and I'm loving it. You want to talk a little bit about what is a debit spread first?
Yeah, so we can start with debit spread because that's the lower risk of the two. And to do a spread, anytime we're talking about a spread, usually we're buying one option and selling another option. Sometimes it can get more complicated, but at the minimum, we're going to buy one and we're going to sell one.
And the reason we do that is to lower the cost to get into the trade. Because if you just buy a call, it might cost you $1,200 or $1,300 for one call. But if you sell the next strike price call, you're going to lower the capital required to do the trade to maybe $200. Let's look at a real example.
Yeah, so when Jack says, 12 or $1,300, he's really referring to his favorite, maybe our favorite stock. And this is a very polarizing stock, Tesla. We start looking at the options chain here about a month out, 4 weeks, where we've been talking about for Gap. And you look at these prices here, we're like $1,500,
That's, that's a
$1,300,
lot of bucks.
$1,200. That's a lot of bucks for one option contract right there.
Well, even
So
more so if you bought the 335.
yeah, yeah, yeah. Look,
18,
go down, going
1850.
down in the money, almost 2 grand. 330 is definitely over 2 grand right there. I mean, that gets to be some pretty rich premium, and you got to be right. Even if you bought this 340, how much move are we going to have to even, how much move up are we going to have just to be break even?
Yeah.
Almost $16.
Yeah.
Almost $16
In the
of
option.
move.
Yeah. Yeah. That's big.
So if we bought that option right there, we're going to have a $16 move higher in Tesla just to be break even.
And $1,600 for one call. That's a lot. That's a lot of money. Now, how could we lower the cost on that?
Now, if we're going to buy that, that's $1,600. So what could we do? We could sell one that's further out of the money. So we buy the one closer to the money. The money's sitting right here. And then we sell one further out of the money. So this one that we bought gives us the right to obtain the stock, and this one gives us the obligation to deliver stock. But the right to obtain it is at a lower price, buy low, and the obligation to sell it is at a higher price, sell high. That's what we want to do, right? Buy low, sell high. This is for a credit or for a call debit spread. At this point, we're expecting price to go higher, hopefully.
So let's do the math there. 1575 to buy the 340 strike price call.
1575.
You're going to bring in
And
1370, say.
then we're going to sell 1370.
And so instead of paying 1575 to get into the trade, you're going to get a good bang for your buck right here for $205 instead of $1,575. Now, your trade, people say, hey, well, you got a cap. You're capped on how much you could make. And that's true, but it might be 200-300%. So if you're just shooting for 50% or more, you really don't care that you're capped out at 2 or 3 or 4 or 500%, right? That's a great way to get into a trade for $205 instead of 1575 and still set yourself up to make 50% or more.
Now, what's the most this trade could be worth? Probably the difference in the strikes. That's $5. So 500. How much did we spend to get into this? 205. So the real upside potential capped out, yes, at $295, but we only need a $5 move, $6 move.
Now, that's interesting you say we only need a $5 or $6 move. Now, that's nothing because Tesla can do that routinely in a day or two.
Yeah.
So not only are you in a trade for very little money, but you're also in a trade that has explosive potential because of the underlying stock. And Tesla is unique like that. It's just unique.
To give you guys an idea, markets are pretty much flat right now. Tesla's already moved $6 just this morning.
Yeah. There you go. So we're looking at 295 upside divided by our 205 cost to get in. That gives us 143% potential upside and only needing that $5 move that's smaller than the move that Tesla's already made today.
Is that just type in? Is that a brilliant trade, folks? You think that's good? You like what you're seeing so far? Let us know. I think that's an amazing trade right there. Love it. Yeah, Samuel, you're right. Love it, John. Yeah, I love it too.
And see,
and you can do a lot more trades too because you're in this for $205. You can do a lot of different trades. Don't have all your money riding on one horse. This is good stuff. I'm glad you guys are buying into it because this is what works, right? If there was something else to do that worked, I'd be doing it. I'm doing this. This is the good stuff right here. Love it, Earl says. Yeah, me too.
So what's the caveat here? Like if price went down, how much do we lose? Do we lose big money? $1,600? No. Our risk is capped at $205.
Yep.
What we spend when we get into this.
That's a good reward right there. Look at that. Only what you paid. That's right. Yeah. Now that brings up another point. I never do anything with options unless I'm willing to lose 100% of what I put into the trade. So it's
me too.
Speculative. Don't look at this as something safe. You have to be able to, take the amount of money you could take and take a lighter to it and not cry about it. And that's how much you could spend on calls. Yeah.
Yeah. The expiration for this particular example was September 12th. We were a month out. If Jack has a system where he does this and he does it much closer to the expiration, maybe it looks like 10 days out, I think is what we talked about yesterday, Jack.
Yeah, about 10 days out. Yeah, it's always the following Friday. And today is the day, if we're going to get a signal, today would be the day. We haven't had it yet. Ruth asks about assignment on a debit spread.
Yeah, so what is the assignment risk? If this thing went blowing through and for some reason, some weird reason, you got called out on your short call, you own this one right here. And what can you do?
Exercise.
Well, one, you could just sell it because it's probably worth more than what you got put or what you got called out for. It's probably worth more. The extra premium on there is probably still worth more. But let's say we're closer to expiration and it's actually closer to just at the money, in the intrinsic value of it. You could just call it. You could call the shares. Now your called shares, you only paid $340 for them. You sold them for $345, and you just did the very thing that you wanted to do: buy low, sell high.
Yeah, we always say when we're doing debit spreads and you get exercised early, that's basically the best possible thing that could happen. You lock in your max profit right there, get it done early.
Yeah, you just locked in selling at the max profit. So there's huge benefit, and it unlocks a little bit of potential that you could potentially make more money because your call may still be worth more, may still have extrinsic value that puts it slightly above and beyond the max gain. It's a small chance, but it's a chance that happens.
Love that trade. Love it.